Fine Business Radio with Lindsay Williams is proudly brought to you by Prudential. All things considered.
It's just after 6 o'clock on Thursday, the 24th of July, 2014. I'm Lindsay Williams, and this is Fine Business Radio on FMR 101.3 FM, brought to you by Prudential. Coming up is an hour of local and international business and markets. And also don't miss Lee Adler. He is the founder of the Wall Street Examiner. He's the editor of the Wall Street Examiner. He used to work on Wall Street and he got rid of Wall Street because he didn't like it. He's always got some great views. He's the most accurate predictor of the S&P 500, in my opinion, that I've ever spoken to. This is Fine Business Radio, FMR 101.3 FM, brought to you by Prudential. Please stay tuned. As I look at my screen, the S&P 500 is trading at 1987. 1987 is a particularly interesting year to me because I was on a desk in London at the time, and October the 19th, 1987, the market fell, the US stock market, the Dow Jones fell by, I think, 22% by the close. I just wonder, when I look at 1987, if the S&P is ever going to fall, never mind 22%, what about 2%? On the telephone now from Florida is the owner, founder and editor of the Wall Street Examiner. His name is Lee Adler. He's the man that's called the S&P for the last 5 years, and he's called it correctly. Any chance of it coming down? I don't know. Let's find out now. Lee, 1987. Any chance of a repeat of that monumentous day?
It's not on my horizon.
Oh, gosh.
But is it out there? I think it's probably out there. We tend to get these crashes every generation or so, and maybe with the manipulation of the central banks in recent years, they've set up another situation where we're going to have another one of those. But from the perspective of technical analysis, cyclical analysis, and the fact that the central banks are still manipulating the markets higher, it's just not there yet. We're not quite there yet.
Okay, let's go back to the previous crashes. 87, I don't know why it went down. There's been lots of analyses on why it went down, but nobody seems to have a consensus. But anyway, it went down in spectacular fashion. It was great fun. Yes. 2000, we had a really big fall as well. That was the dot-com bubble. 2008, 2009, we also had a big one. That was to do with the housing market in the United States. And here we are with Facebook, I think, up today around about 7 or 8%. I don't know if you've seen that. Suddenly, I'm thinking to myself, I've seen this all before. Can it happen again?
Yeah, I do think it's going to happen again. And I think that the theme of unintended consequences is going to rear its ugly head at one point. The unintended consequences of the money pumping that has pushed the markets up as far as it has, they've yet to rear their ugly head, but they will. Timing's the issue, and that's where the technical analysis comes in. And the other thing is that most of these crashes are precipitated when the central banks decide they've had enough, when they've had enough inflation, when they've had enough overheating. After all, central bankers are human beings, and they come under a tremendous amount of pressure, and eventually they succumb to the pressure to reverse their actions. So I think we're approaching that threshold. The Fed is already backing away from quantitative easing, and they're doing it on a steady basis. And by the end of the year, they're not going to be adding much liquidity to the U.S. market. Now, the Bank of Japan has not backed away yet. And I think that's probably going to be a requirement for the markets to fall sharply. But I do think that without the Fed in there pushing the money up through the dealer trading accounts as they have been, I do think that the market will build a top over the next, say, 15 months or so. And we're probably approaching the first stage of that top building process now.
Yeah, it doesn't seem to have the sort of punch that it used to have. It doesn't have the momentum it used to have. It seems to be stalling every time. Okay, we've got the S&P at all-time record highs at the moment, but it's not that sort of, goodness me, let's get in there now because we've got these options that we need to cover and we need to cover the delta and all those technical things. It doesn't have that feel about it. It may be the holiday period. It may be the fact that the market is tired. What is your interpretation of the fact that the market is running out of steam?
Well, we've run into a couple of trend resistance levels that I've talked about with you in the past, and we're hitting up against those now. Those are trend resistance; they're not flat resistance levels, so they do gradually rise. So the market bumps its head against these trend resistance levels, and then it turns sideways, pulls back a little, and then the buyers come back and they bump into that resistance again. So there's this thick band of resistance between the current level of, say, 1985-90 and 2010, 2015 in there. And the market's going to have trouble getting through that. I would be surprised to see it break through at this point, but I would also be surprised to see any kind of significant correction in the immediate future. I think there's still enough liquidity out there to continue this churning, messy, slightly uptrending situation.
But on the other hand, if you had the view that perhaps this is very close to the top, even if the top is only 12 to 15 months away, in other words, that big rounding top that we see on the graphs so often in the past, would you be taking advantage of the fact that the volatility index, the VIX, is so low and keep on buying and rolling some puts, some out-of-the-money put options?
It's probably too early for that. I think you're probably throwing your money away if you're following that strategy. But I think the time is coming where you can start buying puts. I'd like to see that initial break first. I'd like to see some support levels broken. The way tops form is that you get an initial sell-off, and then the buyers come back, and you make a minor new high, and then you have another pullback, and then maybe a test of the high. Tops tend to be processes. Bottoms tend to be events. And I think that in the top building process, traders have time to watch and wait, pay attention to the technical indicators, but it's boring. There's just not that much to be done. I do think that rolling puts, if they're cheap enough, it's not going to hurt you, but it will put you into a hole that will take some time to dig out of, and I don't think we're at that level yet, that time yet.
What do you make of what Janet Yellen said at her last meeting, her testimony to the Senate Banking Committee? Did she say anything that really disturbed you, or was it just business as usual?
I pay no attention to what they say. I get my information about what the Fed says from third parties. But, I did catch that she says we're going to be data dependent. And I don't think that's true. I think that she's made up her mind to ignore all the data. I think, as I may have mentioned to you previously, I think the hawks have won the argument, and they are going to shut down this quantitative easing program, not 100%, but 95%. They're still going to continue purchasing these mortgage-backed securities to replace the ones that get paid off their balance sheet. So the Fed's balance sheet will stay level, but they'll still be buying a little small amount of securities from the dealers every month, and that'll cash the dealers out to some extent. So they'll still have some monopoly money to play with. And but no, I don't think that anything that the Fed heads say really matters all that much. Watch what they do, not what they say.
What about the U.S. economy? You were in Jacksonville yesterday. You're in Florida today. You live in Canada some of the time. What's going on over there?
No, it's interesting because a couple of the indicators that I follow, such as this morning's initial unemployment claims and some of the federal tax collection data, has reached all-time record levels. We're at extremes that have not been seen since the top of the housing bubble. And yet there are other areas of the U.S. economy, as we all know, that are doing extremely poorly. But the appearance of economic growth is driven by the sectors that are doing well. And those sectors of the economy, those indicators are at extremes that probably are not sustainable, that indicate that the economy is overheated in the United States. So if the areas that have been carrying the U.S. economy are overheated, that's not a good thing, because there's not going to be any rotation into those areas where you have massive labor oversupply. That's just not happening. And, the top is sort of carrying the ball here, and the top is stretched to the limit. So I think that the economy is sending some signals that there are danger signs that it is overheated, and that when the Fed does pull back on liquidity, then we're going to face some problems. And I think that's going to be the process over the next year or so.
Okay, you talk about overheating. Does that translate into inflation? Because obviously that's the enemy of the Fed. They're obsessed with the thing.
Well, they don't see inflation because they don't measure inflation. They measure a narrow definition of inflation that excludes all the things that are inflating, particularly assets. Assets are not a part of the conventional definition of inflation. The conventional definition of inflation is based on consumption items only. And, of course, they're not inflating very quickly. But one of the items that is included in the U.S. CPI is housing, and they don't measure that properly. They basically exclude housing prices completely, and they make up a construct called owner's equivalent rent, where they include rent at a contract rent level rather than at a market rent level. So if you signed a lease 3 years ago, they're basing the rental cost component, which is 31% of the CPI, on old leases. And most renters have older leases with built-in escalator clauses of 2 or 3%, or escalators that are based on CPI. So it becomes a self-fulfilling 2% or 2.5% increase in the housing cost component. And we know that housing costs are rising at 6, 7, 8%. Market rents are rising at that level, and housing prices are rising at 8 to 10%. So if you included those components as 31% of CPI, then the U.S. inflation rate would already be 3.5%, 4.5%. And the Fed's never going to see that based on the methodology that it uses. But eventually, the lagging portions of the lagging components of the CPI are going to catch up, and we're going to find out, oops, we have inflation, and it's overheated.
They've got to raise rates, haven't they? They've got to raise rates over the next 5 years to 4.5%, 5%, surely.
Well, I would think so, but again, I don't know, and I try not to speculate on those things. And I think that the quantity of liquidity is more important than the price of money. Most people pay attention to interest rates, and I'm more interested in the quantity of liquidity, the quantity of money that the central banks are creating. Because the Bank of Japan and the Fed express monetary policy only through transactions with primary dealers. So as they pump this cash into primary dealer accounts, that goes directly into the markets first, and the markets are the conduit for transmitting monetary policy to the rest of the economy. So I watch the quantity of money more than the price of money.
I've been following you for a long time now on Twitter. Twitter is one of the shares that we probably don't like because it's overvalued. It's a great service, but it's an overvalued share price. And I've noticed a few sort of signs that you're starting to get tired with the market and starting to talk about the fact that maybe in 12 months, 15 months, 18 months, 2 years' time, we're going to have a fall. But there's definitely a change in tone from you, Lee.
Oh, yeah. I mean, I see the end now. The end is coming. And the end of this bull, I mean, we've been in a bull market for what, 5 years now, and historically
5.5.
Yeah, that's a long time, and time is another element of my analysis. So, as these things extend and get longer, human nature is, again, we're dealing with human beings at the Fed. They're going to reverse course at some point. They're coming under tremendous pressure from their critics, and they may say that they never respond to that, but they do. Ultimately, eventually they do. And I think the Bank of Japan at some point has to be relenting from its massive monetary incursions as well. So once the big two start pulling back from printing money so much, then I think we're going to face the reckoning that has been delayed for so long.
You've just given us the tip of the iceberg. You provide a much more detailed service on a daily basis at the Wall Street Examiner. Tell us how we can follow your work and how we can subscribe to your work.
Yes, I do daily market updates and weekly updates on the liquidity situation. And they're at wallstreetexaminer.com. And you can find information about my proprietary service. That's the Wall Street Examiner Professional Edition. It's right there on the site. And your listeners can try it risk-free for 30 days. Just go to wallstreetexaminer.com.
Lee, thanks so much for your time this evening. That's Lee Adler from the Wall Street Examiner.